For 41 consecutive months, the factories of the world's second-largest economy have been selling their products at a loss. 41 months. That is not a slowdown. That is not a correction. That is the longest streak of falling factory prices since China became a market economy in the late 1970s. And almost nobody outside of economics is paying attention. But they should be. Because what is happening inside China right now is not staying inside China. It is leaking across every border, disrupting every supply chain, and quietly reshaping the price of almost everything you buy. Here is the number that tells the story. In January 2026, China's consumer price index rose just 0.2% year over year. That is half of what economists expected. And it came after December's reading of 0.8%, which was supposed to signal a turning point. It was not a turning point. It was a mirage. The Producer Price Index, which measures what factories charge for their goods, fell 1.4%. That is the 41st consecutive month of decline. And that number understates the reality, because behind it are millions of factories engaged in something economists have started calling involution. Involution is what happens when too many companies are chasing too little demand. They cannot grow. They cannot expand into new markets because those markets are shrinking. So they turn inward and start eating each other. They slash prices below cost just to keep the lights on. They hire fewer people. They pay lower wages. They cut research budgets. They sacrifice the future to survive the present. Margins collapse. Workers spend less because their wages are falling. Demand falls further because consumers are saving, not spending. And the cycle accelerates. The Chinese government has recognized the problem. Officials have launched what they call anti-involution policies, directives aimed at curbing the destructive price competition between domestic manufacturers. They have ordered production cuts in several sectors. They have warned companies against selling below cost. But the orders are contradicted by the incentive structure. Local governments, which depend on tax revenue from factories, have every reason to keep those factories running, even at a loss. Banks, which hold the loans, have every reason to keep rolling them over rather than recognizing the loss on their books. And the companies themselves have every reason to keep cutting prices, because the alternative is closing down entirely. The result is a system where everyone agrees the problem exists, but no one has the incentive to fix it. Over a quarter of all publicly listed Chinese companies are now unprofitable, the highest share in 25 years. To understand how China got here, you have to understand the property collapse. For decades, real estate was the backbone of the Chinese economy. It accounted for roughly a quarter of GDP. Hundreds of millions of households stored their life savings in apartments. The government used land sales to fund local budgets. Banks used property as collateral for loans. The entire system was built on the assumption that real estate prices would keep rising. They did not. Home prices in China have been falling for 4.5 years. This is not a correction. This is a household wealth destruction event on par with the 2008 American housing crash. Except in China, it is still accelerating. 85% of the price gains accumulated over the previous decade have been wiped out. 80 million apartments sit unsold or vacant across the country. New construction starts have fallen to levels last seen in the early 2000s. Major developers that were once considered pillars of the economy have defaulted on their debts or are desperately restructuring. The sector that once accounted for a quarter of GDP and 15% of the non-farm workforce has been effectively abandoned as a growth engine. And the damage is not just financial. It is psychological. When your life savings are locked in an apartment that loses value every month, you do not go out and spend money. You hoard cash. You cut back. You save even more aggressively because you do not know when the bottom is. That behavior has a name in economics. It is called a balance sheet recession. And if that term sounds abstract, it should not, because the world has seen this exact pattern before. Japan, 1990, the setup was almost identical. A massive real estate bubble fueled by cheap credit and speculative investment. When it popped, property values collapsed. Household wealth evaporated. Banks were left holding loans backed by assets that were worth a fraction of their face value. The Japanese government responded with stimulus, but it directed that stimulus toward industry and infrastructure, not consumers. Sound familiar? The result was 2.5 decades of economic stagnation. A generation of Japanese workers entered the labor market, built careers, and retired, all within a single economic malaise. GDP growth averaged less than 1% per year. Deflation became so entrenched that consumers delayed purchases because they knew prices would be lower next month. Businesses stopped investing because they saw no return. And the government accumulated the highest debt-to-GDP ratio in the developed world, over 260%, trying to spend its way out of a trap that required a fundamentally different approach. China's situation is not identical to Japan's. The economy is larger, more globally integrated, and more state-directed. But the psychological dynamics are the same. When households lose confidence in the value of their assets, no amount of factory investment fixes the problem. You can build all the solar panels in the world. If your own citizens will not buy anything, you have an export machine without a domestic engine. And an export machine without a domestic engine is a machine that runs on the tolerance of its trading partners. That tolerance is running out. Chinese consumers are now exhibiting what analysts call luxury shame, a behavior last seen in the United States during the 2008 financial crisis, where people actively avoid visible spending because they feel guilty or anxious about their financial future. Retail spending has been sluggish. Youth unemployment has been persistently high. Wage growth has flatlined. And consumer confidence remains near historic lows despite months of government pledges to fix it. Now, the obvious question is, why doesn't Beijing just stimulate demand? Give consumers money. Cut taxes. Launch a massive spending program aimed at households instead of factories. The answer is political. With the 21st Party Congress approaching in 2027, the leadership is prioritizing two things above all else: political control and technological supremacy. Every major economic decision is being filtered through those two priorities. Instead of stimulating consumption, which would mean putting money directly in the hands of hundreds of millions of citizens, which is inherently difficult to control, Beijing has doubled down on supply-side investment. More factories, more technology, more production capacity. The bet was that high-tech manufacturing would replace real estate as the engine of growth. Solar panels, electric vehicles, batteries, semiconductors. And in terms of production, the bet has worked. China now manufactures 80% of the world's solar panels, 75% of its lithium-ion batteries. It dominates rare earth processing and has built the largest electric vehicle industry on Earth. But production is not the same as demand. The factories are running. The goods are being made. But there are not enough buyers, domestically or internationally, to absorb the output. The result is a global problem. China's trade surplus hit $1.2 trillion in 2025. That means China exported $1.2 trillion more in goods than it imported. That surplus is not a sign of strength. It is a sign that domestic consumers cannot absorb what their own factories produce. So the goods flood outward into Southeast Asia, into Europe, into Latin America, into Africa, at prices that local manufacturers cannot compete with. This is what economists call exported deflation. China's falling prices become everyone else's falling margins. Factories in Vietnam, Indonesia, and India find themselves competing against Chinese goods priced below what it costs them to produce. European manufacturers face the same pressure, and the United States has responded with the most aggressive tariff regime in nearly a century. Not because American consumers do not want cheap goods, but because American industries cannot survive against competitors selling at a loss. The irony is extraordinary. China's internal deflation is pushing down global goods prices. But American tariffs, imposed specifically to counter that flood of cheap goods, are pushing American consumer prices up. So the Federal Reserve is stuck. Underlying global inflation is falling. But the sticker shock from tariffs is keeping headline inflation artificially sticky at 2.7%. The Fed cannot cut rates aggressively because inflation looks elevated. But the inflation is not coming from demand. It is coming from tariffs. And the tariffs are there because of Chinese deflation. Kevin Warsh, the nominee to replace the current Fed chair, has suggested that artificial intelligence-driven productivity gains and what he calls the global deflationary gift from China might allow for more aggressive rate cuts once tariff-induced volatility peaks in mid-2026. But that is a gamble. Because if Chinese factory prices start rising before supply chains have been fully restructured, the deflationary gift becomes an inflationary shock with no warning. The entire global monetary system is being distorted by a feedback loop that starts in empty Chinese apartments and ends in the price of groceries in Ohio. And central bankers on every continent are making decisions based on signals that are being warped by forces none of them fully control. Meanwhile, the companies caught in the middle are scrambling. Apple has spent the last year moving production to India. All United States-bound iPhone assembly is now happening outside of China. Walmart is aiming to source 25% of its imports from India by the end of 2026. Ford's electric vehicle unit is projected to lose over $4 billion this year because it cannot compete with Chinese battery costs. And dozens of companies across every sector are engaged in what the industry calls friendshoring, moving supply chains to allied countries not because it is cheaper, but because it is safer. This is not a temporary adjustment. This is the most significant restructuring of global supply chains since the original wave of outsourcing to China in the early 2000s. Except this time, the movement is going in the opposite direction, and the cost of that reversal will be measured in trillions of dollars over the next decade. New factories have to be built, new workers have to be trained, new logistics networks have to be established, and all of that investment happens at higher costs than the Chinese system it replaces, which means the era of cheap consumer goods that defined the last 20 years is ending, regardless of what happens with tariffs. This is the great bifurcation. The global economy is splitting into two systems. One system, anchored by China, is defined by overcapacity, falling prices, and state-directed industrial policy. The other, anchored by the United States and its allies, is defined by tariff walls, supply chain restructuring, and rising costs. And the two systems are pulling in opposite directions simultaneously. For the average person, this means something very specific, and it depends entirely on where you live. If you live in a country that trades heavily with China but is not behind the American tariff wall, say Indonesia, Brazil, or Thailand, your local industries are being undercut by Chinese goods sold below cost. Jobs disappear. Factories close. Your government faces a choice between protecting its own industries with tariffs, which raises prices for your consumers, or accepting cheap goods that hollow out domestic manufacturing and destroy employment. There is no good option, only trade-offs. The European Union has already imposed targeted tariffs on Chinese electric vehicles and solar panels. India has put up barriers on Chinese electronics. Indonesia is wrestling with the same decision right now. If you live in the United States, you are shielded from Chinese deflation by tariff walls, but you are paying the cost of that shield in higher prices on everything from cars to electronics to construction materials. The average American household is paying hundreds of dollars more per year in indirect tariff costs, and that number is rising as supply chains restructure at higher costs. If you live in Europe, you are caught in the worst position of all, exposed to Chinese overcapacity flooding your markets while simultaneously facing American tariffs on your own exports to the United States. European manufacturers are being squeezed from both sides, and the European Central Bank is cutting rates into an economy that is growing at just 1.3%, barely above stagnation. There is no neutral position in this system. Everyone pays. The question is how. Goldman Sachs projects China's economy will grow 4.8% in 2026. That sounds healthy, but strip away the export surge and the government investment, and the domestic economy is barely moving. Consumer inflation is projected to stay below 1% for the entire year. Producer deflation may not turn positive until the third quarter, if it turns positive at all. And the property market has not yet reached its bottom. New home sales are forecast to fall another 7% this year after an 8% decline in 2025. The drag from real estate is lessening, but it is far from over. China's public debt-to-GDP ratio has expanded by 40 percentage points since 2019, reaching 116% in 2025. Local governments, which once funded themselves through land sales, are drowning in debt. They are keeping zombie companies alive by rolling over loans and protecting local employers, which keeps overcapacity entrenched and prevents prices from recovering. The debt deflation spiral feeds on itself. Prices fall. Real debt burdens increase because the money owed is worth more than when it was borrowed. Borrowers cut spending to service their debts. Demand falls further. Prices fall again. And each turn of the cycle makes the next turn worse. This is exactly the mechanism that Irving Fisher described in 1933 during the Great Depression. It is the same mechanism that trapped Japan for a generation, and it is now operating at the scale of the world's second-largest economy, an economy that accounts for roughly 18% of global GDP and is the largest trading partner of over 120 countries. When an economy this large enters a deflationary spiral, it does not suffer alone. It exports its suffering through every trade route, every supply chain, and every financial market connected to it. This is the trap, and Beijing has the tools to break it. Direct cash transfers to consumers, a massive social safety net expansion, a deliberate reduction in industrial overcapacity. But using those tools would require a political choice that the current leadership has shown no willingness to make, putting consumer welfare above state-directed industrial strategy. Eurasia Group, one of the world's leading political risk firms, has named China's deflation trap as one of the top global risks for 2026. Their assessment is blunt. The leadership will prioritize political control and technological supremacy over the consumption stimulus and structural reforms that could break the cycle. Beijing has the means to prevent a crisis, but living standards will deteriorate, the fallout will spread abroad, and the world's second-largest economy will remain stuck in a trap of its own making. For the rest of the world, the implications are clear. If China reflates, if factory prices start rising at the same time supply chains are being restructured away from China, the world could see a sharp reversal from deflation fears to a new wave of cost-push inflation. Energy, metals, and raw materials would spike, and central banks that just finished dealing with one inflation crisis would face another. If China does not reflate, if the deflation persists and deepens, the exported deflation continues, global margins keep compressing, and the pressure on every trading nation to choose between the American system and the Chinese system intensifies. Either outcome reshapes the global economy. There is no scenario in which this stays contained. And here is what makes this moment different from every previous Chinese slowdown. In the past, when China's economy wobbled, the rest of the world could absorb the shock because global trade was flexible and tariff walls were low. Cheap Chinese goods flowed freely, consumers benefited, and the adjustment happened through markets, not through politics. That world no longer exists. Today, every flow of goods crosses a political boundary. Every supply chain decision is filtered through a national security lens. Every price is shaped not just by supply and demand, but by tariff schedules, sanctions lists, and diplomatic relationships. The global economy is no longer a single system with shared rules. It is two systems with competing rules, and China's deflation trap is accelerating the split. Companies that once sourced freely from wherever costs were lowest now have to choose which system they belong to. And that choice, American tariff wall or Chinese price floor, determines their cost structure, their margins, and their survival for the next decade. The trap is set. The clock is running. And the decisions being made in Beijing right now will determine whether the world's next economic shock comes from too little demand or too much. To stay ahead of these shifts and understand what they mean for the global economy, make sure you are following this channel, because this story is just getting started.